What are Federal Reserve stress tests? Have you ever wondered how banks prepare for economic challenges? Federal Reserve stress tests are a key part of that preparation. These tests assess whether large banks have enough capital to survive severe economic downturns while still lending to households and businesses. The Federal Reserve creates hypothetical crisis scenarios, such as high unemployment rates or significant drops in asset prices, to evaluate the resilience of these banks. The results of these tests determine how much capital banks must hold in reserve. This is vital because it ensures they can absorb losses without needing taxpayer-funded bailouts. From a conservative viewpoint, these stress tests act as a safeguard against financial instability. However, they are often criticized for imposing a heavy regulatory burden on banks. Republicans generally support the idea of stress testing as a tool to prevent systemic risk in the financial system. They believe that while these tests are necessary, excessive requirements can limit banks' ability to lend. This, in turn, can stifle economic growth. Conservatives advocate for market-driven solutions rather than strict regulations, pushing for rules that are tailored to fit the unique needs of different banks. The tests involve several key components. First, they simulate severely adverse conditions, which include sharp declines in gross domestic product and significant stock market drops. This helps assess whether banks have adequate capital to withstand such shocks. Second, banks must maintain a stress capital buffer above minimum requirements, which is calculated based on projected losses. Lastly, the results of these tests are published annually, promoting transparency and accountability in the banking sector. The practical application of stress tests aims to avoid a repeat of the financial crisis of 2008. They ensure that banks remain solvent during economic downturns. However, critics argue that the process can be too rigid, especially for smaller institutions, which may struggle to meet the same standards set for larger banks. Conservatives often call for proportional regulations that do not hinder community banks and regional lenders. While Republicans acknowledge the importance of stress tests for financial stability, they frequently advocate against expanding regulatory complexity. They argue for streamlining requirements to reduce compliance costs. Overregulation can divert resources away from productive lending, which is essential for economic growth. The focus remains on balancing prudent oversight with free market principles to encourage competition and innovation. Stress tests also play a role in monetary policy by influencing credit availability. Stricter capital requirements, driven by stringent stress test outcomes, can limit lending during economic expansions. Conservatives emphasize aligning these tests with pro-growth policies to avoid unintended negative effects on the economy. Federal Reserve stress tests are an essential part of the financial regulatory framework established after the 2008 crisis. While they are supported for their intent to maintain stability, there is a strong push for reforms to ensure that regulations protect the economy without stifling growth. The ongoing debate centers on finding the right balance between oversight and allowing the market to function effectively.